Markets are selling off big time today. The Nasdaq is down about 1.3% heading into tomorrow's Fed meeting. We need to talk ASAP. Besides your cannabis stocks, in which we did bag an over 900% winning trade on, most of the markets are declining quite a bit today. If you take a look at the stocks, percent of stocks above their 50-day moving average, 6.5% of all stocks on the markets today are falling below their 50-day moving average. That's a pretty rough day across the board. By the way, cannabis stocks did well today because the Biden administration moves to reclassify marijuana. Cannabis, whatever you want to call it. And it's been a Schedule 1 substance for more than 50 years. Apparently, the U.S. Drug Enforcement Administration is expected to approve an opinion by the Department of Health and Human Services to reclassify marijuana as a Schedule 3 substance, NBC News reported, citing 4 sources with knowledge of the decision. So basically, that'll open you up to being able to use banking services and to take out loans, things of that nature that these stocks have not been able to do, and the reason why they're in the dumps. So I think that could still be a pretty good trade heading into the next couple of days. But that is neither here or there. The 10-year Treasury yields are rising about 7.5 basis points today. 10-year Treasuries are now trading at 4.69% if you round up slightly here. And a lot of this was because of that news we got yesterday. In the current quarter, the Treasury is expecting to sell about $41 billion of additional treasuries. That is causing an upside pressure to Treasury yields today, and that is not great. Now, you also had some economic data that came out today, pretty stagflationary. So a couple different data points. Let's start with the stagflationary data, or what could be stagflationary data. You had the ECI, the Employment Cost Index for quarter over quarter Q1, came in at positive 1.1%. The estimate was 0.9%. So this ECI is basically saying, hey, what's the cost of labor quarter over quarter? And it's going up 1.2% quarter over quarter. That's not great. That is an input cost to companies, and companies are going to want to pass that cost on to consumers. I mean, if you're a company, would you rather pass your costs on to consumers or take the hit to margins? If you can possibly pass that cost on, they're going to. So that's kind of stagflationary data. You did have the S&P Case-Shiller home price month over month that came in at 0.9%. The previous month was negative 0.1%. And the estimate for this month's number for the month of February was 0.6%. So housing is still going up on a broad-based metric, and that's obviously not great for housing inflation. Year over year, house price index came in at 7%, estimate was 5.9%, and month over month came in at 1.2%, the estimate was 0.5%. So house price index month over month and the S&P Case-Shiller home price month over month both came in much higher than expected. So that's not great. Pretty inflationary data in the housing sector. But then at 9:45 this morning, you had the Chicago PMI that came in at 37.9. Estimate was around 44. So that came in lower than expected. So Chicago area, economic activity came in lower than expected. And you had this inflationary data in the housing market and the ECI. And then you had CB consumer confidence that came in at 97, a big drop compared to the estimate of 104. Markets were actually expecting that you were going to rise on a month over month basis for CB consumer confidence. You fell big time. The estimate was 104. You came in at 97. Last month was 103.1. So across the board, lower consumer confidence, pretty inflationary data with that ECI report and the home price data that we got, and weaker economic activity. What does that spell? That spells a stagflationary environment. Economic activity that is starting to fall or get worse, and inflationary pressures that are still persisting. That's not great. That's another reason why 10-year Treasury yields are rising today and stocks are selling off. You also had Just to add to the stagflationary argument, Dallas Fed Services Index came in at negative 10.6. The estimate was negative 5. So service activity around the Dallas area, which is really like Dallas, Oklahoma, right? Kansas, just kind of spread it out a little bit in a circle. That's kind of what this data incorporates, that area. That came in much worse than expected. Dallas Fed Services Revenues Index came in at 0.3. Estimate was 3. So just, yeah, that's not great for that region, and that really adds to that stagflationary argument that the data presented today. Now, again, the Fed will be tomorrow at 2 p.m. You'll get the statement. At 2:30 p.m., you will get the conference from Powell. There's two different ways to look at tomorrow. There's the balance sheet and Fed policy. Now, let's start with the balance sheet. So the Fed's currently running off about $60 billion in treasuries per month and about $30 billion in mortgage-backed securities per month. We're expecting those numbers could fall by 50%. So the Fed could announce they're going to sell $30 billion a month in treasuries now and $15 billion a month in mortgage-backed securities. It could fall more than that. It could fall less than that, but that will help offset some of the selling pressure in the bond market, meaning maybe you'll see a little bit less selling pressure, and that could mean bond yields could fall. When you get selling pressure in the bond market, think about TLT, the ETF for the 20-year treasury. It works for the 10 or 30-year treasury as well, really long duration. When you get selling pressure here, treasuries fall, TLT falls, thus yields rise because the actual yield itself is fixed on treasuries. The price of treasuries fluctuates, and that's what gives you the fluctuation in yield. So less of this selling pressure on TLT could mean maybe you stabilize TLT a little bit, or TLT can actually rise a little bit, and that could be good for treasury yields. Now, if the Fed does, reduce it less or more than 50%, if they go down to $20 billion a month in treasuries that they're going to sell, that's like a $40 billion a month stimulus from the Fed that could help offset some of the additional issuances in treasuries from the Treasury that we're expecting over the next 3 to 9 months. So that's one aspect of the Fed coming tomorrow. And I think there's reasons to be optimistic there. Now, the Fed might announce, hey, this is what we're going to do, but we're going to start at next meeting. That's always a possibility as well. Or maybe the Fed says, hey, we're doing this and we're going to start this now. Maybe there's a little delay in the reduction of the size of their balance sheet. Now, second thing to consider with the Fed is the actual Fed policy. Now, I will tell you right now, as far as the Fed Rate Monitor tool, this is a tool that you guys can use. Just type in Google Fed Rate Monitor tool. You'll pull up investing.com. And you should pay very close attention to this really on a day-by-day basis, if not a week-by-week basis at the bare minimum. If you take a look at the December 18, 2024 Fed Funds Futures contract, there's a 42% chance of only one cut this year. So markets are only expecting one cut this year. In fact, there's a 26.3% chance of 0 cuts this year and 24.4% chance of 2 cuts. So there's a greater chance that there is 0 cuts than 2 cuts this year. And again, the base case is 1 cut this year. That cut is currently expected in November. On November, wait a minute. Oh no. That's not good. Hold on. November 7th, there's a 43.1% chance of no cut. Wow, we're now only pricing in the first cut, December 18th, 2024. Holy moly, that just changed big time. We were previously expecting the first cut in September, and then it just skipped November and went straight to December. Wow. Oh, wow. That is pretty incredible. I'm going over this with you guys for the first time, so that's my dead honest reaction. Wow. Okay, so for tomorrow, you are priced as if you're barely going to get 1 cut, and it's going to be December 18, 2024. If the Fed signals that they are not going to cut rates in 2024, or if the Fed signals they may need to raise rates in 2024, that becomes very problematic for the markets. Now, especially if they say they might need to raise rates. Now that's super bad for markets. Markets would sell off big time tomorrow. My base case is still the Fed plans to cut 2 times. I still think the Fed is planning to cut more than 1 time. So I actually think this rise in 10-year treasury yields today, this sell-off in stocks today, presents an opportunity for tomorrow, because I do think the Fed is not going to change much. And if the Fed doesn't change much, they're still going to come out tomorrow and sound very dovish relative to market expectations. For the first time in a long time, the markets are expecting less cuts than the Fed. And, maybe that ultimately happens. We are seeing some stagflationary data, but there's also reasons for the Fed to consider, like, hey, we may need to start cutting rates. Look at quarter-over-quarter GDP that came out last week. It came in 1% lower than expected. And look at the data that we just got today, consumer confidence, all of, the other data that is pretty stagflationary. Yeah, I still think the Fed's going to cut rates multiple times, and I think that could be seen as a huge positive for markets. And again, with a sell-off like you're seeing today, that turns into a very big positive coming tomorrow. So I do think there's a big opportunity there to make some upside calls for tomorrow. Now, that's obviously not a recommendation. Do what you guys want to do, but that's personally what I'm looking at. Now, today in after hours, right at about the time you guys are watching this video, Amazon, AMD, and Supermicro will report earnings. AMD, Supermicro had a pretty rough day today. Basically, everything had a pretty rough day today. I think Amazon's going to come in good, just for the record. This is before earnings come out. I think Amazon's going to be good, and I think Supermicro and AMD are a bit of a wild card. AMD doesn't tend to have the greatest earnings when they report, and that's why AMD has given up a lot more. But Supermicro is definitely on the chopping block here if they did not pre-report earnings, because earnings are going to be bad. And earnings are bad today, then that could really sour the mood for the entire market. So I think that is a big question mark heading into tomorrow, that if we get more downside in the markets from here, it's probably Supermicro and AMD that caused that. You also have Pinterest, Caesars, Root, Lemonade, Riot, Starbucks, and Anuk that report earnings today and after hours. And then pause this video if you guys want to see the rest of these companies. But I do think today and after hours is really the last big day for market moving earnings this week. You do have Apple on Thursday, but everyone's expecting Apple to be bad. I think Apple might be priced for really bad. Apple may actually be able to do okay on earnings if it's not as bad as expected, and especially if margins do hold up. Now, here on the day today, if we go ahead and refresh the CNN Fear and Greed Index, you're sitting at 42 today, which is a little bit more fearful than you were yesterday when you were at 43, but not as fearful as you were a week ago when you were at 39. So maybe there's room to go either direction here. You're almost in the middle at neutral today. Overall, I do think really the next 24 hours is going to be super volatile for stocks. But I am bullish on especially small cap stocks heading into tomorrow. I think the markets are pricing a super aggressive hawkish Fed, and I don't think the Fed's going to be as hawkish as the markets are expecting. And I think that can give a drop to 10-year treasury yields, and I think that can give quite a big boost to the small cap stocks. Now, what happens in after hours is definitely going to dictate what happens to big tech with Amazon earnings, as well as SMCI and AMD. SMCI is still about 2% of the Russell 2000. So depending how they report, that could have a huge outsized effect on the small caps as well. But I do think this sell-off today, this drop today, does present an opportunity to be bullish heading into tomorrow. Now, if stocks were ripping higher today by 1%, I would be a little bit more bearish heading into tomorrow. As I explained in the last video, if stocks rally into the Fed, you probably want puts. If stocks sell off into the Fed, you probably want some calls. So stocks have pretty much sold off heading into the Fed. I think you want some calls for tomorrow. But again, I'm not a financial advisor. Contact one if none of this information makes any sense and you are new to trading. This is not a recommendation. You can and probably will lose all of your money if you listen to me and or trade options. So let me know what you guys think about this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.